Nigeria's banking sector has entered a new phase following the completion of its recapitalization exercise, with the focus shifting from raising capital to deploying it effectively. After 33 banks successfully met the March 2026 recapitalization deadline, raising about 4.65 trillion naira across the industry, Proshare argues that future competitiveness will depend on capital quality, governance, earnings resilience, and market valuation rather than balance sheet size alone. Teslim Shitta-Bey, Chief Economist and Managing Editor, Proshare, joins me for more on this. Thank you so much for joining us today. Yeah, sure. So your report argues that, beyond the conversation has actually shifted from capital adequacy to capital effectiveness. What exactly does that mean?
Oh, thank you very much for the question. If you look at the recapitalization exercise that occurred in 2004, 2005, under the then governor of the CBN, Charles Chukwuma Soludo, the thing that was of great importance was scaling Nigerian banks to larger sizes. So you had increased capital and larger sized banks, larger sized balance sheets, total assets, 10 times what they were in the past. But over time, we've realized that, yes, you could be big, but are you effective? Is your capital being deployed in the most efficient manner? And so with the new exercise, we saw a pivot towards increased attention being paid on the quality of capital as well as the size of the capital. And for us, that was interesting because part of what we discovered in our report was that even though size of capital has increased, you find out that in some instances, the capital accumulation, its effectiveness has gone in an opposite direction. So you have greater amount of capital, but is it efficiently deployed? So in some of the banks that we've analyzed, we see some of them having negative real adjusted returns on equity. That's those big words to say that if you adjust the returns on equity by inflation, they're actually negative, even though they have recapitalized, and so they have greater capital. So what that means is that they need to sweat that capital a lot harder for them to be able to match up to the expectations of investors like yourself and myself.
Oh, that's interesting. Beyond capital effectiveness, I want to know if, what the CBN is doing is also subsumed in that. The CBN is doing something called, the risk-based regime now for the banks. So how does that align?
Yes, absolutely. It's important for us to understand that a bank could increase its loans and advances because it has more capital. It could increase its loans and advances. But what is critical is the quality of those loans. Yes, I increase my loans and I perhaps put it in a particular sector that finds it difficult to repay the loans. The loans have actually increased, but the quality of those loans have declined. So CBN is saying that, no, we're not going that route again, because we went that route before and it didn't really work out as we expected. So this time around, first of all, they made sure that they cleared what they called forbearance. Now, clearing forbearance is that CBN had not taken sanctions, imposed sanctions on the banks because of their poor loans. He did not impose those sanctions and forbore actual policy actions. Now, in doing that, it allowed the banks to continuously operate as they had always been operating. Within the new exercise, first of all, CBN says, no, you have to clean up your books. So the first thing you do is that when you bring all that money in, I'm taking out all your forbearance, so your books are clean.
Are they totally clean now, or do we still expect some of them to still take out some monies to forbear loans?
Well, the point is, with the way the CBN has gone about it, it's largely clean. But don't forget that when you accumulate loan assets, some assets can actually still go bad. But the good thing about it is within the context of this framework, you're going to see that even if they do go bad, the CBN will be right on top of it. And that's what they're talking about when they're looking at risk-adjusted supervision. So that if I feel that there's a weakness in the quality of your assets, I move quickly and intervene in it.
All right. I think I would like to highlight some of the things you mentioned regarding capital effectiveness. You talked about clean, loss-absorbing balance sheets and productive intermediation. I'd like you to speak to these. I think you sort of tried to talk about them a bit, but productive intermediation, what would that mean for the economy?
It will mean quite a lot. What it means is that there will be increased inclusiveness you're intermediating in such a manner that those in the rural areas, for instance, have you noticed that fintechs, neobanks, and the conventional banks are coming to a meeting point? And some banks actually have tech foundries. Even CMOs, capital market organizations, are also recruiting some fintechs to support operations. So we're beginning to see a merging of the financial system, and there's increased intermediation amongst these organizations. So the reach of some of these banks is much wider than it was in the past, and it's more effective and efficient because it's based on digital technology. Many of them are improving significantly in technology deployment, and that's the kind of thing we should be encouraging, even though we are still behind maybe Kenya with its M-Pesa, and maybe Egypt also, but we are getting there. And the more we intensify and deepen that integration, the better the financial services system will be for not only large cap institutions. By large cap institutions, I'm talking about largely capitalized institutions. Even smaller institutions will have increased access, and they will have perhaps lower interest rate charges.
All right, so talking about the PBS, I'd like you to speak to us about the top 3 discoveries really and why they matter.
Okay, so there are 3, it means you really did a good job on reading through. There are 3 principal discoveries that we found there. Nominal values and real values seem to be going in opposite direction. So what I mean by that is that if you don't take into account inflation, it seems as if we're doing very well in terms of returns that investors get. But when you adjust for inflation, which currently is at 15.91%, we are not doing so well. Let me give you an example, for instance. If you look at the inflation-adjusted return on equity for a GT, it's 8.75%. So just before you get to that question, which I know you're going to get to, Wema came into the picture. But what is Wema's inflation-adjusted return on equity? 21.03%. So it's not just about size, because don't forget, Wema's currently, I think, about 260 billion naira in equity. GT is way higher. So, but you see that Wema Bank is being efficiently run in such a manner as to improve its returns on investment and equity. Those are the kind of narratives that we saw in the report. That's one of the narratives that we saw in the report anyway. And then there's another narrative that is of interest. If we took about 45 African banks selected, largest ones selected, and we saw that the price to book value was 0.99. Now, what does that mean? Okay, so if you wanted to wind up the bank, you perhaps lose about 1% of the total value of the bank because it's only 0.99. So there's 1% that is not there and you don't have access to it because it won't be there. Now, let's look at Nigerian banks. Even as of today, Nigerian banks are between maybe 0.5, 0.6. The best will perhaps be about 0.7 as of December 31st, 2025, because I need to make sure that that is emphasized. There have been some changes post-recapitalization. Yeah, so there have been some, but as of that time, Nigerian banks were significantly underpriced from their book value. And what we saw in
has the repricing in the market been significant so far?
Well, it's improved because
maybe.
Yeah, I knew you would say that. but yeah, it has improved, right? So we're talking about 1.33 now for some of the Nigerian banks, of which you mentioned one. So 1.33 price to book value, which is good. So the book value of that bank is at least matches his book value. The price of the bank matches his book value. So that's the kind of narrative we want to see with more banks, especially the former Fugas, who have now not become Fugas anymore because it's been disrupted.
We'll still keep calling them Fugas.
Okay, fine. So the tier 1 banks actually, a few of them are still underpriced. But we feel that with the kind of results we're seeing now, many of them are actually sweating that additional capital they got. They're sweating it, So big is beautiful, the new era.
All right, that's interesting. Let's close with this now. With recapitalization now completed, what should investors be watching in the next, say, 12 to 24 months?
Well, the thing about it is first and foremost, the fear of the CBN is the beginning of wisdom. And why I said that is this. The good thing is that we will likely see greater loans and advances taking place in strategic sectors, which should stimulate growth. However, the banks are going to be careful because, like you pointed out earlier, there are risk-weighted concerns that the CBN will continue to monitor. So you just simply can't say, oh, I have a lot more money now. So you go to one particular sector and say, you know what, I want to do Father Christmas. So here's the Father Christmas bonus. No, that won't happen. The banks are going to be very cautious. They're going to be very concerned about the quality of loans. So sectors now will be very selectively invested in, or at least loans given to them. So I think going forward, investors are going to be conscious of the various sectors of the economy and how the growth of that economy is evolving and how the growth of that economy is being internalized in Nigeria. And let me just quickly say this. For instance, one of the fastest growing areas of the Nigerian economy is entertainment. But how much of that entertainment value is actually resident in Nigeria? Within the week, we've heard about Nigerian artists doing so well. I won't mention names, but they did so well globally, and they're streaming heavily. How much of that streaming money comes into the Nigerian economy to help boost the entertainment sector itself, as well as provide liquidity for the banking system? Very little. Even in terms of tax, very little too. Most of those...
you don't want to have that conversation.
Yeah, but the truth is, Nigeria needs to grow at about 7 to 9%.
I guess we'll have that conversation some other time about, GDP growing at 7%. Thank you so much for joining us today and sharing
Thank you very much for having me.